Hello students, how are you? Will you remember what we have discussed in the previous class? Okay, today's lesson or today's class is regarding about the business transaction and the accounting equation. Before that, let us revise what we have discussed in the previous class. In the previous class, we discussed Unit 1, the first subtopic, that is the concept and the principle of accounting. Under the concept and the principle of accounting, we discussed that the meaning and the nature of accounting. Under the meaning and the nature of accounting, you discussed the definition of accounting and the three basic activities of accounting, that is identification, recording, communicating, and the key components of accounting definitions, the key components of accounting definitions, and the nature of accounting, and the importance of accounting, why accounting is important, and some users of accounting information. Who are the users of accounting information? Then the accounting principles and the concepts. Accounting principles and the concepts we discussed. And the field of accounting. Also the field of accounting, you discussed some job options of people in accounting field. And the forms of business organizations also. These are what we have discussed in the previous class. Today's lesson or today's class is regarding about the business transaction and the accounting equation, which is the second subtopic of Unit 2. Therefore, let us start from the meaning and the types of business transaction. Here, what do we mean the business transaction? Here, business transaction is any economic activity that can change the financial position of the state or an entity, state of an entity. This business transaction changed the financial position or the state of an entity. It is also measurable in monetary value, so it can be recorded for accounting purposes by the accountant. Also, it involves the exchange of goods and the exchange of services or funds between two parties through selling or buying or by assistance. Or it consists at least two parties, at least two parties. One is the buyer, another is the seller, or one is the producer, another is the consumer. Therefore, it consists at least two parties, and also it consists the definite period of time on which the exchange is made. Let us discuss the feature of business transactions. The features of business transaction include measurability. The transaction is measurable in monetary terms, that is a feature. Non-measurable activities are not included in the business records, and they are not business transactions, such as recruitment of the employee. Hiring employee is non-business transaction. Purchase order is non-business transaction. Receiving emails, for example, is non-business transaction, but it is activity of the business organization. Therefore, business transaction is a transaction that is measurable in terms of money. That is the main feature of business transaction. Transactions may be external or internal. Transactions may be internal or external. The transaction is on behalf of the business entity, and it is not a personal transaction of an employee or the owner. Transaction is signed by authorized person. It must be authorized. and the seal or the stamp must be sealed. Otherwise, non-authorized transaction is not recorded in the records of business books. Also, transaction is analyzed before recording on the financial document. Business transaction must be analyzed. These are some features of business transactions. Let us see types of business transactions. Business transactions are classified as internal transactions and external transactions. Internal transactions are the economic events or transactions that occur entirely within one company. Within one company, that is internal transaction. For example, the use of cooking and cleaning supplies for XY cake and a restaurant, for example, this transaction is taken in one department to another department in the same organization. Such type of transaction is internal transaction. Another one is the external transaction. This external transaction involves economic events between the company and some outside enterprises. For example, here XY Cake and the restaurant purchase cooking equipment from a supplier which is outside the organization, and payment of monthly salary, for example, payment of monthly salary to the employees, which are outside of the organization. Such type of transactions are external transactions. Let us see examples of the types of business transactions. For example, here purchase transaction is one type of transaction, buying goods or services from another party or within a department in one organization. That means the purchase of transaction. It is the purchase transaction. Another transaction example is sales transaction. For example, sales transaction, selling goods or services to another party. Payment transactions, transfer of cash to another party to settle a debt or some obligations. Receipt transactions, for example, receiving funds, cash from another party. Transfer transactions, moving funds between accounts, such as from a checking account to a saving account, is transfer transaction. Loan transaction, borrowing or lending money, which involves agreement to repay the borrowed amount with the interest, is loan transaction. Here purchase transaction, sales transaction, payment transaction, receipt transaction, transfer transaction, loan transaction are some examples of types of business transaction. Let us discuss the elements of financial statements affected by the business transaction. Elements of financial statements that are affected by the business transaction. According to the International Accounting Standards Board, elements of the financial statements are categorized as directly related elements to the financial position or the balance sheet, and directly related to income statements like income and expenses. Here, directly related to the financial position or the balance sheet are assets, liability, and equity. These are the elements, financial statement elements affected by the business transaction. Here, income and the expenses are the financial statement element also, if affected by the business transaction when we are preparing income statement. Let us discuss one by one. Assets first. Let us see assets. Here we can classify assets, current assets and non-current assets, intangible assets. Here, current assets like cash, account receivable, short-term notes receivable, supplies, inventory, and the short-term investment. These are some examples of current assets. Here, current assets are the assets that can be converted into liquid form of cash, liquid cash. For cash within 1 year, such type of assets are known as current assets. Assets are what the business owned are known as assets. Such assets are current asset or non-current asset, what we call fixed asset, and intangible asset that we cannot see, we cannot touch, are known as intangible assets. And the non-current assets, examples: property, plant and equipment, long-term investments, long-term notes receivable are some examples of non-current asset or what we call fixed assets. Building, for example, equipment, machinery, so on are non-current asset, what we call fixed asset. And intangible assets, for example, goodwill, copyrights, patent right are some examples of intangible assets. These are the assets category or asset accounts. Another element of financial statement is liability. Liability. This liability is some obligations that the business organization must pay. Liabilities are what the business owed are known as liability. We can also classify liability as current liability and non-current liability, like as assets, current asset, non-current asset. Liability also classified as current liability, non-current liability. Current liabilities: accounts payable, salary payable, short-term notice payable, rent payable, and the utilities payable are some examples of current liabilities. Liabilities that can be paid back within 1 year are known as current liabilities. But liabilities that cannot be paid in 1 year, but they are paid more, take time period more than 1 year, for example, for within 2 years, within 3 years, within 4 years, are examples of non-current liabilities or long-term liabilities. Liabilities are the creditor's claim on the assets. Okay, another element of the financial statement directly related with the balance sheet or financial position is equity. Equity, the ownership claim on a company's total asset is known as equity. It is equals to total assets minus total liabilities. In order to determine the equity, we have to subtract total liabilities from the total asset, then we will get equity. The owner's claim on the assets is known as equity. It is often referred to as residual equity. The equity left over after creditors' claims are satisfied. Okay, another element of financial statement which is directly related with the income statement is an income. Here, an income. Income increases in economic benefits in the form of inflows or enhancement of assets. Revenues arise from the ordinary activities of a company and take many forms here, such as sales, fees, interest, dividends, and rents are some examples of revenue arise from the ordinary activities of a company. Gains are income arise from non-ordinary activities of the company. Gains are other income. They are categorized as other income or other income group. Gains on the sale of long-term assets are examples of other incomes. Therefore, income which is arise from the ordinary activities of the business organization and other income which are different from the ordinary activities. The last element is the expenses here. Expenses is directly related with income statement. Therefore, here expenses decreases in economic benefits in the form of outflows or depletions of assets or the incurrence of liabilities that result in decrease in equity. These expenses decrease in equity, but incomes increases equity, which these are the different from drawings. Drawing is different from expenses. Here, drawing for personal purpose, sometimes the owner of the business withdraw money for personal use, not for business use, but for personal use. Such type of decrement in capital are recorded in the drawing accounts. Such type of expense, such type of decrements in a capital are recorded in drawing accounts. Therefore, drawing is different from the expenses. Expenses are generally arise from the ordinary activities of a company and they take many forms, such as cost of goods sold, depreciation, rent, salaries, and the wages, and the taxes are some examples of expenses from ordinary activities. Here, losses represent other expenses that meet the definition of expenses and may or may not arise in the ordinary activity of a company. Here, losses include losses on restructuring charges, losses related to sale of long-term assets are different from ordinary activities. Here, expenses arise from the ordinary activities of a company. Okay, let's discuss about the transaction analysis, business transaction analysis. Business transaction analysis is very, very important. What is business transaction analysis? This is the act of examining a transaction to decide how this transaction affects the accounting equation. It is the first step in the accounting cycle. It requires to ask and answer the following question. Analysis of transaction requires to ask and answer the following questions. For example, what are names of accounts affected in this transaction? The first question. What is the effect of each account? Another question. What is the classification of each account in the chart of accounts? And what is the increase or decrease side of each account? And lastly, what is the amount of each account? These questions must be arised or must be asked and answered in order to analyze business transaction. Okay, examples of transaction analysis, let us see. For example, Rahel company paid cash for month of September expenses of office rent per 600, salaries and the wages of employees per 900, and the utilities per 200. This is one example of a transaction. This is, for example, one example of a transaction. Paid cash for months of September. Payment of cash for September expenses is payment transaction. This is a payment transaction. Therefore, in order to analyze this transaction, the first question is what are the name of accounts affected in this transaction. Therefore, in this transaction, here cash account is affected, rent expense is affected, salary and the wage expense is affected, and the utility expense is also affected. Totally, 4 accounts are affected in this transaction. The second question, what is the effect of each account? Effect means the change of each account. What is the change? This transaction made what type of change? How changed? This is another second question in order to be raised in analysis of transaction. Therefore, here cash is one account. Therefore, here cash is decreased through payment. When we pay cash to expenses of salary, expenses of rent, expenses of bills. Here, cash account for the business organization will reduced or decreased. Therefore, decrement or cash decrease is the effect of cash account, and the rent expenses increased. Salary and the wage expenses increased. Utilities expense increased for the organization. At the time of payment of expenses, cash is decreased and the expenses are increased. The third question is classification of each account. For example, when we analyze transaction, the third question, what classification? What are the classification of each account affected in this transaction? Here, cash is classified under asset in the chart of accounts at the beginning of the operation of the business organization lists the name and their number of accounts in as a chart. Therefore, that is known as chart of accounts, and in this chart of accounts there are asset classifications, liability classifications, equity or capital classification, revenue classification, expense classifications. Therefore, at the time of analyzing, we have to ask what accounts affected, the affect accounts, how they are classified in the charts of accounts. Therefore, here cash always is an asset. All accounts are expenses. That means rent expense, salary and wage expense, utility expense are expense accounts. They are categorized or classified under expense accounts. Another question, increase or decrease side of each account here. Increase or decrease side of each account. What is the increase or decrease side of each account? Must be asked and answered. Here, assets. The increase side for asset is debit, and the decrease side for asset is credit. Whereas expenses, increase side is debit, decrease side is credit. Lastly, what amounts are affected? What amounts are affected in the transaction? Amount of each account here, cash, the total expense, the sum of total expense is 1,700 birr. That is the total amount of cash affected. Cash. Rent expenses 600 birr. Salary and the wage expense 900 birr. Utilities expense 200 birr. These are amounts affected. By asking such questions and answering through analysis, then we can record in the financial documents. You will discuss financial documents in the next class. In general, let me tell you, or the increase and the decrease side of accounts. Accounts, all assets, the increase side is debit side. Don't forget this. All asset accounts, the increase side is debit and the decrease side is credit. For all liability accounts, the increase side is credit, the decrease side is debit. And for all equity accounts, the increase side is credit, the decrease side is debit. For all revenue accounts, the increase side is credit, the decrease side is debit. For all expense accounts, the increase side is debit, the decrease side is credit. This is made through the principles. As we discussed in the previous dual aspects or dual principle, at least two accounts affected in one transaction, at least. But now in this transaction, 4 accounts are affected. That means more than 2 accounts can be affected. But at least that is must. At least 2 accounts must be affected in one transaction, and one is debit, another is credit. The debit amount must be equals to the credit amount. That is to make the account equation in balance. Therefore, here the debit side and the credit side principle is the one assumption or principle of accounts which is set by accounting principle setting bodies. Transaction under the transaction analysis and equation, let us discuss the basic accounting equations. The basic accounting equations, therefore. The basic accounting equation is the relationship between two basic elements of the business. What it owns, assets, and what it owes, liabilities. What it owns is known as assets. What it owes is known as liabilities. Here, the relationship between two elements is known as accounting equation. We can express the relationship of assets, liabilities, and equity as an equation. Assets always is equals to liability plus owner's equity. This is the accounting equation. The accounting equation applies to all economic entities, regardless of size, nature of business, or the form of business organization. It applies for all business entities. This asset is equal to liability plus owner's equity. What we call the accounting equation applies for all business entities. You can refer this in your module, page 24 up to 29 of your module, to understand the transaction effects on the basic accounting equation. Okay, this is enough for today's discussion. The next discussion will begin to communicating with users.